Today we're taking a look at an alternate version of exercise 7-3 from Chapter 7, Reporting and Analyzing Receivables. This problem is the alternate version of the problem found on page 342 of the textbook, dealing with the direct write-off method. Now, the direct write-off method of accounting, as the LearnSmart modules mentioned, is not approved by GAAP, generally accepted accounting principles, but it is a nice way to kind of get introduced to the topic, so let's take a look at the problem. It says Dexter Company applies the direct write-off method in accounting for uncollectible accounts. Now, March the 11th, Dexter determines that it cannot collect $8,500 of its account receivables from its customers, Lester Company. So Lester bought some stuff in the past. They said, we'll pay you on this IOU called an account receivable. But come March the 11th, Dexter said, you know what, we've learned that Lesters are schmucks and they're not going to be able to pay us back. So we have to do a journal entry for that March the 11th transaction. March the 29th rolls around and Lester Company unexpectedly pays its account off in full to Dexter. Dexter's like, well, okay, maybe you're not schmucks after all. You pay us back, okay. We'll take the money. Of course you're going to take the money. So Dexter records its recovery of this bad debt expense. We need to prepare journal entries to record the above selected transactions for Dexter. So let's begin. First off, that month of March is going to show a carry forward balance, a debit balance that Lester Company owes of $8,500. So that subsidiary ledger right off the bat is going to show the amount that they owe us, and this was from the sale that done at some point in the past. They don't tell us when in the past, but we know that this is an amount that the customer, Lester Company, owes us. So let's go to the March the 11th transaction. And on March 11th, when we find out that this company is not going to pay us back, this customer is not going to pay us back, we write it off on that day in this direct write-off method. And so the journal entries would look like this. The first thing is we're going to charge that amount off, and we're going to charge it off as a bad debt expense. It's actually going to lower our net profit for this period. It's going to become a new expense. And so part of the problem with the direct write-off method is it doesn't follow the matching principle. This sale to Lester Company was a sale from a previous period, but we're writing off the expense in a different period, and that violates the matching principle that says that costs have to be matched up to the period where that helped to generate the revenues for that period. So direct write-off method is not GAAP because why? It violates the matching principle. But let's go ahead and do the direct write-off method anyway, just to show you how it would be done. And the bad debt expenses, we're going to debit those for $8,500. And then we're going to erase the receivables from Lester's account for $8,500. And this transaction is just simply to do that, write off the account. So we're going to credit $8,500. And now Lester has a zero balance. We've charged off, we've taken an expense of $8,500 in the month of March for a sale that was done in another period before March. Now March the 29th rolls around and we find out that, oh wow, Lester is going to pay us back all of a sudden. Surprising, but we're thrilled, so we'll take the money. So the transaction to record this looks like on March the 29th, that receivable is going to get restored now to Lester. We just wrote it off. We had that March the 11th transaction where we took it off their ledger subsidiary account. Now we're going to be adding that back. So we're going to debit their account for $8,500 again. And that bad debt expense that we just recorded, well, we don't have it anymore. So bad debt expense is going to get credited for $8,500. It just cancels out. This debit on March the 11th is now getting canceled out by this credit on March the 29th. So we're reinstating this previously written off account, just undoing in its entirety this March the 11th transaction. So what happens then is all of a sudden we get that balance back up now of $8,500. On March the 29th, we also have to record that we received the cash. So cash has now gone up by $8,500. We debit cash because cash has increased. And then finally, we're going to apply that cash to Lester's account with a credit for $8,500 that brings their balance back down to zero again. So let's just kind of look at the steps here real quickly again. When you realize the customer is not going to pay you under this direct write-off method, you charge that off, and you charge it off on the day that that happens, not when the sale was made, but on the day that you realize the customer is not going to be able to pay you back. And what principle is that violating again? Matching principle. So when you do that, when you charge it off as a bad debt expense, it brings the customer's balance down to zero. Later on in the future, if you get a recovery, if the customer winds up paying you back, first thing you do, step one, is to reinstate that previously written off transaction. So we're just going to undo what we did on March the 11th. And that's what's shown here on the T accounts. And then last, you apply the cash to the account, and that brings the balance down to zero.